Now, let's focus on tuning up your knowledge by learning the latest investment trends. Please welcome to the stage Team Jeff, Chief Investment Officer Jeff Alvander, and Director Investment Research Jeff Keeling.
All right. Veronica finished early, so we wanted to have a little more slow ride song intro. But welcome to the investment tune-up, where we're going to take a couple laps around the track to make sure all of your investment lineups are firing on all cylinders. That wasn't too cheesy, was it? Sounded really cheesy when it came out to me. But we're keeping it in the theme of drive. So the first lap around the track is going to be, and I need a clicker, I think, that I didn't grab, is going to be ESG, right? We all know what that stands for: environmental, social, and governance factors. We talked a lot about this last year, about how ESG meant a lot of things to a lot of different people, right? All the rating agencies were all over the place. In fact, we were seeing low to negative correlations in terms of how one company was rated by one company versus another company. All right, so over the last year, we did a lot of research. We looked at all of them to figure out, all right, what are we going to be programming? What's the ESG stance? What's the rating we're going to have in the system for all of you? So that's what I came up here to tell everyone tonight. But last night, Nick and Jesse let everyone know who we were going with, right? Who was here last night? And it is MSCI, right? Right? Everyone was here. All right, so why am I here? All right, you guys need to ask the question, right? Vince said it last night. What's the question? Why MSCI ratings? Why did we choose MSCI? In the theme of the conference, because we're having some fun here, right? Let's take a 1984 Ferrari Berlinetta Boxer 512i out on the racetrack. It's a flat 12 cylinder. I think it's got about 500 horses to it. And we're going to take that out. Anybody know what famous video that car's from? No? Shout it out. No? It's what Sammy Hagar drove. I can't drive 55. But most importantly, it's a 5-speed. And there are 5 reasons why we chose MSCI ratings. So let's do the first one. First, they are an ESG leader in Europe. Europe is way in front of the US in terms of ESG. And in fact, now most of the managers over there apply ESG in their investment philosophy in some way, shape, or form. So a lot of these investment managers have been relying on MSCI for a long time now. And really what MSCI is doing is they're bringing over a lot of that, what they've already created, over to the US. And in fact, a lot of US managers now are incorporating MSCI into their screening or into their investment process. So that's first gear. They're a leader in Europe. All right, let's shift to second gear. Deep resources. Out of all of the providers that we looked at, MSCI far and away has probably the deepest resources. Big budget, a lot of dollars going into this initiative, making it a priority in the US. Right now they have over 200 analysts and growing. All right. Let's shift to third gear. And it's because of their use of alternative data. How many of you want these companies scoring themselves? saying, hey, I'm good in ESG. Give me a 10 in E and the S and the G, right? Probably not the best, and probably everybody's going to grade themselves as great for ESG. So MSCI's use of alternative data really minimizes the reliance of that reporting and disclosure, voluntary disclosure by all of these companies. So we felt that was important. All right, so now we're shifting to what, fourth gear? How fast are we going now? I have no idea, but we're going fast. We're not there yet. Fourth gear, use of technology and artificial intelligence, or AI. And that's really just to increase the timeliness of the data. And that's not only the ESG ratings that we will have in the system for everyone, but that's all the data that they get to create all of these ratings for all of these companies. And we'll get to what that rating looks at, but this makes it much more timely and much less stale if something's changing over the month, quarter, et cetera, or even year. All right, now we're getting to top speed, fifth gear, 5-speed. Broad coverage, this is an important one. When you look at all of the providers out there, you certainly want the broadest coverage, so most of the investments or the fund options are being rated. And right now, MSCI has over 53,000 fund portfolios that are rated, with over 140,000 different fund share classes. So that is extremely important as well. And that number is just going to continue to grow as they sort of make tweaks. They've already indicated some changes to us in terms of maybe lowering some of the percentage that the portfolio must have. So we see that number going higher, but extremely important, and a lot of the providers out there don't have as broad of coverage. So how is the ESG report going to look in our system? And we have some slides here that we will show everyone, and these are our ESG resources. And it's going to start with a methodology page to review what these ratings are. We're calling them ratings, not a score. And first off, we're going to look at, when we look at all of these funds, we're going to look at how they do in the E, in the S, and the G. So they're going to get rated in those lenses specifically. So you may have some clients that want to just look at the environmental piece of it, governance, I don't know, but those will all be separate. And that's in the far left-hand box. And then MSCI rolls all of those up into one ESG score for the fund, makes some adjustments, gets to a number score, and then converts that into a letter grade. So from AAA being the best, think of bonds, AAA is the best, all the way down to a CCC. So identifying the leaders and the laggards. And what all of that entails underneath all of that, it's all holdings-based analysis. So MSCI is looking at every company within the fund, and they're undertaking this evaluation, looking at all those characteristics separately, again, from a holdings base, like what stocks do they own, what fixed income investments do they own, and rating those. So it's all holdings based. And you'll see right now, yeah, they have over 8,500 securities companies measured. So that will set the table. That'll be the first page in the report, just like our scorecard, how we have the methodology overview. That's the ESG overview. This provides a little information. We'll have this as well in terms of what that number score is, translated over into the ESG rating. And you'll see here who the leaders are, AAA to AA, who are average and who are laggards. And really, it's just the exposure to those categories and those characteristics. So if they're, I guess you can call it an ESG event, for the positive, that could potentially help the companies or the funds that are leaders in that category and that have those exposures. Potentially, if there's and it could negatively affect those fund companies that don't have those ESG characteristics if there's an event in that space. And so that's maybe how you can look at this. An example of the report, it's going to be a separate report from the scorecard, but we are going to have the score alongside the ESG rating, and you'll see it here. The score is on the far right. The ESG rating is highlighted, where you can see the AA to AAA, how they're scored, and we'll have those highlighted with those shades, those colors, along with the assets, the asset class, and the ticker, along with those three different lenses I talked about if you wanted to drill down into the E, the S, or the G. One of the funds is not scored here. What we are seeing are there a lot of fixed income funds that are not scored. Right now, the number is about 65% of the portfolio needs to be rated for the entire fund to have a score. A lot of fixed income funds have mortgages, government debt, treasuries that aren't rated. So because of that, a lot of them are not scored. MSCI is looking at, I spoke to some of the tweaks they're doing. They may be lowering that threshold a little bit from 65% maybe to 55. We'll see. And so that may include some of these funds. Or they may start scoring the US government. That could change things. I don't think they are going to do that at any time soon. So that's an example of the report. One final note on this, and if the thought is coming to anyone, why didn't we incorporate the score is still very much separate from our ESG rating. And just to note that with all of the discussion and talk about ESG, I know there's a lot of studies out there. I will say the evidence is still inconclusive. There are a lot of studies that say, hey, ESG works in identifying those outperformers. There are some studies out there that say ESG doesn't necessarily work, or maybe that's after fees. And so we kept it separate because the factors that we look at in the scorecard still are really, truly the best ways to identify skillful managers and what managers will outperform in the future going forward or not. And so it didn't make sense at this time to incorporate ESG into that score. So definitely supplemental. A lot of clients are going to want to see how their lineups score from this perspective, and some may have lineups that pass with flying colors, and that's great. Not something, we think that's going to be a staple and something in every report, but maybe just more to the extent that clients do want this and they want to see this or ask for it. Certainly in maybe sales presentations too. It's a great resource, something that you can speak to, that you have the ability to run. And we'll see as the conditions change out there and we get more guidance, which right now has sort of gone a little back and forth, right, with the administrations and what's going on with ESG, that certainly may change, but right now that's sort of where we're at. And for those clients that are still looking for an ESG option, and in fact, we've built one, which we've talked about over the years, for having a one-stop shop for everything ESG. We still think that balanced fund, which has sustainable in the name, balanced sustainable, is that great solution that you can plug into a lineup where it's clearly identified. And we've talked about this one in the past. It's our balanced sustainable ESG fund run by Pioneer Stocks and Bonds. It's Amundi Pioneer. Amundi has been in Europe managing portfolios from an ESG stance for a long, long time, and they brought over that culture. But now we get to score it from an ESG rating perspective, and they are a leader in that space at a double A. So that's our ESG. It's our 5 speeds. I think I covered all of it. A great solution here for one-stop shop, or again, your clients, when you run this, you may find they have an ESG lineup, but another part of the due diligence process, something that you can incorporate and look at based on the client situation and what you're trying to accomplish for your clients. But with that, we have a great solution here as a one-stop shop, but we have a lot of other great solutions, and Jeff is going to take us through, do a lap around the manager due diligence track. So Jeff, all yours.
All right, well, thank you, Jeff. So the plan today is to do a review of our manager selection process, but I want to spend more time today on the monitoring process because that's really where the rubber hits the road and is a very important part of the process. As you know, our process starts with the scorecard. We start with funds that score 9 and 10, but that is literally just the tip of the iceberg. That is where we start. There is so much more that goes into our manager selection process that goes beyond the scorecard. You've probably heard me say this before, but if there's one word of what we're trying to identify with our managers, that word is consistency. And what I mean by that is we want to see consistency of team, consistency of process, consistency of long-term results. One of the factors that and ingredients that leads to that consistency is having a very well-defined process. We want to find managers who are looking for very specific criteria in their security selection process because that is repeatable. Additionally, we want to make sure the managers that we use with our clients have strong risk controls in place, not only from a top-down organizational standpoint, but how they construct their portfolio, making sure that they mitigate risk as they construct the portfolio. One of the other factors that we look at a lot is not only have they outperformed and how they performed over different market environments, but what drove that outperformance. And so we look a layer down into attribution, and what we want to see are managers that their excess returns or their alpha are being driven by security selection because that is repeatable. If you've got a process that you're looking for very specific criteria, do that year in, year out on a bottom-up basis, letting stock selection or security selection drive the work. That makes it repeatable, rather than managers who may make big top-down calls or large sector bets in and out of sectors. Those are less repeatable processes. So this is just a snapshot of the search process, and it is rigorous and it takes a lot of time. These are our two most recent searches that we've done, large cap value 3 and large cap growth 4. You can see we start with the universe of over 3,000 options, and through the scorecard we narrow that down further. We then do, of all the funds that are scoring well, a robust review of all the quantitative factors and narrow that search down even further, where we get to that point where we start engaging the manager, sending due diligence questionnaires and setting up calls with the team in our investment committee to go through all those qualitative aspects that we talked about. And we get down to usually 2 or 3 that the committee has a high degree of confidence in, and then we go to work negotiating the best prices in the industry for you and your clients. These two examples, large cap value 3 is JP Morgan US Value, managed by Claire Hart, probably, if not the best, one of the very top large cap growth managers in the United States. We're still finalizing pricing on that one, but large cap growth 4 is American Century Ultra. This is a strategy that the committee was very excited about, a very institutional process, as well as how they construct the portfolio that has led to exceptionally consistent returns over time, and delivering that strategy to you and your clients at a 42% discount. So you think about that process that we go through, starting with the score that we know identifies manager skill and all the other work that we do. Certainly after you've done all that, the managers that we select are going to score 10s from here to eternity, right? Oh, no. Okay, good. I was hoping nobody said yes. That's not realistic. All managers are going to spend time on the watch list. In fact, the very best managers will spend time on the watch list. Expect it. Expect that to happen. Because there's no process that can outperform in all market environments, right? And so our monitoring process, you know, it's one thing. We do a lot of work selecting these managers, and we're very confident in them. But the monitoring process is where we spend all of our time. Quarter in, quarter out, getting updates with the managers, seeing what trades they're making, make sure they're sticking to their discipline, and analyzing their performance. But in that process, the other thing that we're doing is studying what's going on in the markets. What factors are working, or what factors are out of favor? What styles are outperforming or underperforming? And that is key to put some context around the performance that we see from our managers. It is not in the best interest of participants to continually be flipping managers in and out of the lineup. It's just not. So you've got to be prepared for when we do have these inevitable times where you've got managers where we've done all this work up front, we know they're great, but they're going through temporary underperformance, and being able to stick with them through some short-term pain. So let's talk about some examples. Here's some funds, live examples from the last quarter. Looking at these funds, I see there's one that scored a 4, there's one that scored 5 for 6 consecutive quarters. These must be some pretty terrible managers, right? That's not good. Well, the reality is no. These are actually all 3 focus list managers that have been on our focus list for over 8 years. And what we do when we inevitably have a manager that we've liked and we know that they add skill, that go through short periods of temporary underperformance, we make sure the team is still intact, the process is intact, and if we understand why they're outperforming, we hold the line. And that's because that's what's best for participants. Again, we know that no manager can outperform in all market environments. So this quick example, small cap value, it shows 6 quarters scoring a 5. This one actually scored a 5 for 8 quarters. We kept it on the focus list. We told clients to hold on. Why? Why would we do that? It scores a 5. Were you crazy? No. When we look at the process, what was their process? They tilt down in cap. They tilt towards deeper value. They avoid the bond proxy sectors of utilities and REITs. Well, what just happened in the markets? We just had a historic outperformance of growth versus value. Large caps outperform small caps, and with rates going to 0, bond proxy trade worked. There is no scenario we would expect them to perform well. In fact, had they performed well, I would have been much more concerned that they weren't following their process and their discipline. So we stuck with these managers, told our clients to hold on. And now, while they actually are still on the watch list because they haven't scored acceptably for 4 consecutive quarters, they all do now score acceptably. But now look at the performance. The market is a mean reversion machine. When you go through periods where a style or a factor is so far out of favor, it will mean revert and in a violent way. That's why we hold on to these managers when we understand why they are underperforming despite the score. We just talked about our selection process. We would never add a manager to our lineup solely based on score. We would never also replace a manager solely based on score. There's much more that goes into it. Now, we can't promise you that our CITs are always going to score 10. That's just not realistic. But what we can do, and we do, is provide you all the resources you need when we're going through some of that short-term pain. So, 1, we have quarterly write-ups on every one of our CITs that explain process and the team. They explain what's going on with the score and any sort of market factors that are impacting the score. Additionally, when they do, some eventually hit the watch list, we'll provide additional due diligence slides that walk through in detail what's going on in the market that is leading to the short-term underperformance and the reasons that we have conviction in those strategies. So, sometimes, look, again, all managers are going to spend some time on the watch list. When we do that, when that happens, sometimes, in the words of Foghat in our walk-up song, sometimes it's better to slow ride, take it easy, think about why the score is what it is, what's driving that, and oftentimes we feel like that's going to be the best for participants. So I'll turn it back to Jeff.
Yeah, thank you, Jeff. And we have a pretty impressive group. Your investment committee, the RPAG investment committee, has over 125 years of investment experience. We have former portfolio managers, of which Jeff is one, managing a $3 billion portfolio, equity analysts, fixed income specialists, and it's great to be able to work with all of them. And as we put the scorecard into place for that monitoring, right, to protect everyone as fiduciaries, we put it into place, of course, with the watch list which I had one conversation with one committee. They had their outside counsel there. They're like, oh my, this is a 6. It's on watch. There's a lot of exposure. I'm like, no. That's the fund that we're talking about, right? It's the funds up for removal that have been on watch list that are up for removal. You're deep diving into those, and the IPS requires action, right? So it's either remove the fund if it's on watch or on watch for over 4 quarters, or if it's a 4, or remove it. And so digging into the fund and knowing about it, having those conversations is critical. Those quarterly write-ups are critical and very helpful. And I call the scorecard, that's the X-ray, right? I think a lot of us have used that term, that's the X-ray, but it really does take, right, we're all doctors, physicians, to determine is the patient healthy or not. So all of that qualitative analysis that we do is immensely valuable. And so use that, we're trying to get it out there, and share that with your clients for some of these funds that are watch listing, because the performance here is very impressive when you do hold on to some of those managers where we have identified that they are in fact skillful, but maybe their strategy is out of favor. All right, volatility, our last lap around the track is going to be market volatility, and we've certainly witnessed and been through a lot, right? With COVID going down, coming back up, and now with the most recent bear market and inflation in the headlines. So how do we address it? And being at committee meetings, I love getting the question, Jeff, what should we be doing now? What are the new investment options that we should be putting into the plan? Right? With everything going on right now, is it tips? What should we be doing? Well, we've been doing it all along, right? We're preparing our clients, our plan sponsor clients now for times like these. So everything that you have been doing, you want to continue to keep doing. So, and oftentimes, right, change is good. People think, hey, I need to do something different or change something. That's what's required. But in this case, it's a lot of what we've discussed over the years and talked about in terms of building efficient menus and having just those core lineups, right? We heard Joel this morning, Cash Cab, right, talking about tons of investment options, and in fact, that example was in the hundreds, so craziness. But what I'm talking about is having what's efficient menu design, having, of course, the target date fund series and the 5 vintages, and we count down from there, the 4 corners in the U.S. equity market space, the 3-pack, 3 index funds, U.S. international fixed income, having 2 fixed income funds, which short duration, intermediate, long duration, right? So core plus, stable value, having 1 international, and that's the countdown, 5, 4, 3, 2, 1. Don't forget the 0, right, to lift off, which is 0 specialty funds. We don't need specialty funds or sector funds or any of those. That's confusing for participants. And that's really all you need. Sure, you're going to have a lot of clients that, yeah, I like EM, I like high yield, I like REITs, and there's other category, mid-cap, right? Mid-cap's a popular one. And okay, that's great. Let's add some of those, but this is really where you should start. And in fact, all of these options, if you have the 4 corners in the U.S. active equity space, you have mid-cap with your small cap managers and your large cap managers. You do, right? You have high yield with your core plus managers. You have emerging markets with your international managers. Let them determine the best time to invest in emerging markets or not, or high yield, right, when that's appropriate or not. REITs, they're a part of your U.S. equity portfolios. So efficient menu design still makes a lot of sense. Getting participants diversified, limiting those options, still makes sense today. So there's suitability analysis, and you've heard about this. I think we have one of the best target date fund suitability analysis methodologies out there. I really haven't seen one that comes close to what we're doing here in terms of looking at risk across a glide path. I haven't. I mean, they're all still like, oh, well, what's to and through? It's like, wait, wasn't that conversation yesterday? Let's look at risk of the glide path, right? There were some jokes about it this morning, right? Conservative, moderate, aggressive, important, right? Your demographic is going to fit in one or all of those risk spectrums. So I think this is key to what we do. If you're not using this, I mean, there's certainly different variations on it in terms of deferral rates and how that correlates, but pretty powerful, not only to current clients, but in the sales process as well. And then last but not least, as fiduciaries, we have a responsibility to not only help monitor and select the investments, right? So that's one piece of it, but what's the other piece? That is education. So we have a lot of these resources out there. We try to put these out when specific events happen over the course of the year. Here are just a few of them because education is extremely important, right? So tips to weather a turbulent market, the war on investors' minds. That's when Russia went into the Ukraine, playing conversions in volatile markets and market pullbacks. And so the market pullbacks is just a great reminder, right? We're in a bear market now. Hey, this happens. This will happen, so you need to expect it. I think I've heard, right, if you can't stomach a 50% drop in the U.S. equity market, well, maybe you shouldn't be invested in the U.S. equity market. But this is because, again, this is retirement, so it's all long-term, right, in that positioning as well. So look for these resources. They're all online in the Knowledge Center, and again, one of our responsibilities as fiduciaries, alongside everything else, which we covered a lot from the investment perspective on this course. So we did have one more lap, and we're at the end of our time, so that's good, but I know Joel gave us back a couple of minutes, so we usually give Joel minutes. We're going to take Joel's minutes today. From Marissa. Mr. Bitcoin, crypto, there's been a lot going on in the crypto markets this year. We had a fun video last year with Mr. Bitcoin. He couldn't join us today. I think he's going to be out a little later. You can say hi to Mr. Bitcoin. But for those of you who were here last year, we invited Mr. Bitcoin to come in, meet with the RPAG Investment Committee, where we determined at that time, well, not appropriate. Certainly this year has been a very lively year for him, and certainly being added to some plans, the volatility. So we asked him to come back to meet with the RPAG Investment Committee and figured, well, instead of presenting on that, we might as well show you that committee meeting. So let's roll the video, and there's a little recap in there too for those of you who weren't here last year. So let's roll that video. We invited you here today to really learn a little more about you and to determine if you are a suitable and appropriate investment for retirement plans.
All right, well, let's talk about how you're valued. Are you backed by any assets, or do you generate earnings, cash flow, dividends, interest payments?
Listen, Pops, I ain't got none of that.
As it relates to retirement plans,
No.
At this point, we do not feel you are a suitable or an appropriate option.
You'll all be sorry. Give me that shirt back, too.
There you go.
Evan. Hello, RPAG Investment Committee. How's your year been?
Better than you, I'd say.
I'm sorry, who are you?
I got you a shirt this year.
Thanks, buddy. What's this say? Cryptocurrency crash. Oh, good one, buddy. Thank you. I think it should go, it's better this way, actually.
Welcome back, Mr. Bitcoin. It's been about a year since we last saw you, which is why we invited you back in for an update.
Yeah.
How How are you doing?
I'm all right. I'm pretty good.
All right, okay. Looks like it.
Yeah, last year's been, it's been interesting.
Are you okay?
Yeah. Year's been good. Year's been good. They named an arena after me. You know what they say, fortune favors the brave.
Well, congratulations. So looking back at my notes from last year, we determined that your price is wildly volatile.
Yes.
Your carbon footprint is about the size of Portugal, according to you.
Portugal, yes.
The competitive landscape is extremely crowded, and you have no intrinsic value.
Well, that's good, right?
Those are not the qualities that we look for in a retirement investment.
Oh, Diet Coke, no ice, thanks.
No, this is our ERISA attorney, who we asked to join so we could gain a little bit from his perspective.
Oh, a lawyer. Do you do personal injury?
No.
Well, surely someone as smart as you would be able to educate these fine committee members about the appropriateness of Bitcoin in retirement plans.
Just this past year, the Department of Labor issued a compliance assistance release that essentially warned fiduciaries of the significant risks that they'd be taking with participant accounts due to things like fraud, loss, theft, primarily driven by your speculative nature, volatility, the fact that participants have a difficult time making informed decisions about you, none of which takes into consideration the fact that there are regulatory, valuation, and record-keeping concerns. That's the DOL's perspective in a nutshell.
Well, who cares what the DOL says anyway?
Well, just about every fiduciary I know and with whom I've worked, and maybe every other fiduciary that's concerned with meeting ERISA's high standards of care under 404A.
Oh, away with you. Enough of your fancy words.
All right, well, thank you, Mr. Bitcoin. I think we have heard enough, and I'm sorry to say that at this time we still do not think you're an appropriate or suitable investment option for retirement plans.
Okay, I was thinking you might say that. If you're not interested in Bitcoin this year, maybe I can interest you in some of these things I've been working on. They're called NFTs.
Is that a monkey?
No, Bored Ape. Each one of these is worth
I don't
$50
think
million.
so. No, not today.
Well, you may not be the dumbest guy in the world, but you... Diet Coke? No, not again. No, not again.
Wait, was Mr. Bitcoin just stolen?
It happens more than you think. 14 billion in crypto was stolen in 2021 alone.
$50 million. Yeah, right.